Ladies and gentlemen, welcome back to another episode of What's on Your Mind. I've got Edward Shek and Berggreen joining me on the call today. Gents, pleasure to have you as always. Now, it's worth pointing out today that we do have an FOMC statement being released later. We're filming on Wednesday, February 1st. So where the market's trading now isn't necessarily where we'll be in a few hours' time, never mind when the episode is released. But we'll get things underway anyway. I know you guys are pros, you can deal with that kind of uncertainty. Ed, let's go to you first. What have you got for us?
Hello, boys. Pleasure to be here. I've got three ideas tonight. The first of which is Arista Networks, ANET, $37 billion company, communications equipment sector, stocks trading about 126. And this is a pure play on AI data center build out. So a brief shout out to Ben, whose C3 AI stock pick of not so long ago is up about 100%. So Arista Networks supplies the networking solutions, which means operating systems, network applications, Ethernet, switching, and routers. Okay. Obviously, AI has been generating a lot of interest. We're all aware of Microsoft's $10 billion investment into OpenAI, ChatGPT. And we know Meta is spending tens of billions of dollars on their rollout into the metaverse and all the AI capability. So the lion's share of all the investments coming from the four hyperscalers. So we're talking Microsoft, Meta, Amazon, and Google. So we know that it's a hot topic. We know there's huge amounts of investment. Why are companies doing this? Well, it's to further automate processes, improve customer service, increase efficiencies, competitive advantage, better analytics on vast amounts of data. But it's also the next evolution of just getting rid of as much human labor as possible. And this is a trend that's going to continue. And you can even argue that the ongoing structural tightness in the US labor market, can't find the staff, can't find the right staff, not as efficient potentially as these sort of AI processes, is a secular tailwind. Now, I'm not buying this because I think it's going to be a soft landing or Powell's going to say something in an hour and a half's time that's going to give tech a just good old bull market. I'm not buying this because I think the Fed's going to cut rates, unleashing a big rotation out of energy and into tech. I'm buying this on a standalone basis. Now, one of the difficulties in tech at the moment, and you can look at cyber and obviously look at Microsoft's business, is it's not that they're not growing their revenue and earnings. It's because the rate of change is slowing. And what this basically means is, you're growing at 41 quarter, then to 35, and then to 30, like Microsoft's cloud business. That's still amazing. But all their clients are in the real economy. All their clients are managing a cost problem, lower earnings, lower revenue. They're managing their businesses for a slowdown. That's not a great environment for advertising, IT budgets increasing. Arista Network, on the other hand, when you read something like Meta's last earnings report, they're sacking people, laying off people, cutting costs to fuel their increasing investment in AI. And they said that the only area of IT net spend, CapEx, is in AI. When you have a look at the stock performance, you'll see that the stock's held up incredibly well. And when you look at the quants, for the last 3 years, they've beaten and guided up revenue and earnings for each of the last 12 sessions, which obviously raises the specter that if they disappoint now, the stock's going to get a good hammering. But the investment's there, okay? So it's very different from a company that, it might beat its earnings, but the earnings are lower than last quarter. This is just a staircase up. When I look at the valuation, it's traded in a P range of 37 to 20 over the last year, and is currently at 23 times. So if it's in a hot sector, and if I think that the investment, which is going to lead into obviously their business, is going to withstand potentially even a hard landing, why is the rating collapsed? Well, in the last two earnings, their margins have missed. Their margins had been in the mid-60s. They've fallen to about 62. So why? Margins down, PE rating down, valuation down, stock price being held back. And they're very explicit on their call. They've had, like Caterpillar this week, ongoing supply chain problems. They make their kit in China, and the costs have been going up. And as a result, they've had orders cancelled, not fulfilled. They have to pay more to expedite the orders, and shipping costs have remained pretty sticky. They've explicitly said that if we got more kit back, we could sell it all tomorrow. Demand is outstripping supply. Now, for any of you who watched my last long idea in Pinge, this was another business that's got a competitive advantage, more demand than supply, and huge supply side constraints. Now, that stock's still up 30% since last What's on Your Mind. My real catalyst is simple. As China reopens and supply chains hopefully normalize, their margins should increase. If their margins increase, their rating should increase. We know that they're selling more kit, and if they can sell it for a higher margin, your sales are going to go up, the demand's there, your earnings go up more than the sales go up, the leverage is there because your margin's going up, and then we can get to the price target. Now, when you think of the AI value chain, the chips, the processors is where the high value is. So why don't I want to buy something like NVIDIA or AMD? And AMD's up 8% today. Well, the problem, or the reason why I haven't, is they've got big retail-facing businesses. And while my opinion actually is the data may look soft at the moment, but when you're slowing the economy down, it doesn't just go elevated down to a hard landing. You will have to pass go. You will have to pass soft landing. So my view is that the data will deteriorate through time, and we're more likely to have a hard landing, which I think is the headwind from NVIDIA and AMD. Earnings estimates and revenue have not been guided up over the last few months. When I think about structuring the trade, I've actually gone through a June vertical. So full year earnings are expected to be $5.50. This is for 2023. They report the end of Q4. They report Q4 22 in a week or two. So I'm not expecting necessarily that the numbers to actually smash it, because I don't think their cost situations have improved markedly. So I've gone to June to get another earnings report, but we need to hear some chat about margins starting to improve, products starting to flow more, because they can place it. They could place it today. So if the stock's on 23 times and earnings are expected to be 5.5, you get to where the stock is now, about 126. My estimations are for earnings to get upgraded 10%. I think the PE could get back up to the 26, 27 level, and I get a full year price target of about 160. So the structure I've put on is the June 135, 155 vertical. So if you're spending $5,000, you'll get an 8 versus 8, and you'll get, the 135, 155, and that will give you about a 3 for 1. So it's not a huge return, but it's good enough. Okay, I've got the extra time to see the margins come through. So it's very, very simple. I think their revenue growth is as steady or as stable as I can find in the tech space. They've got a big kicker, which is just margin expansion from supply chains. It's been held back quite recently, although starting to rally, and I've got plenty of time. So that's it. Arista Networks.
Nice. A great long to kick things off, Ed. Ben, let's go over to you. Have you got any longs to add on to that?
Yeah, I do. I have a long and a short. I'm going to cover a completely different space than Ed. This is a stock called Navios Maritime. Okay, ticker is NMM. It's a operator of cargo ships. All right, so these guys operate pretty much a wide range of different ships. So it's not a lot of the cargo vessels is either like dry bulk or container ships or tankers. All right, so these guys do all three. and it's a small company. Market cap is not even is right underneath $1 billion. It's a small company. Next earnings is going to be on February 10th. So this is kind of an earnings play. But really, what got me interested in this, we pay attention to a lot of economical releases and what's going on in the global macro world. And something that I watch quite closely is iron ore. And I have a chart up here, and you can see, but iron ore has increased over 50% since November of last year. From 80 to like 125. And this company, even though they transport diversified, load of cargo, their really the primary shipment is in bulk. Okay, and in that is iron ore. They have 87 ships that's is in the bulk category, and they can handle over 10 million deadweight tonnage, which is basically the capacity of one of these ships. And iron ore is the biggest portion of it. And also, there's also being an uptick in the prices and demand for this based on the China reopening. So China had everything shut down, zero COVID policy. They just said, screw it, we're just going to open everything up. Since then, there's been some shifts in base commodities like this, where all of a sudden there's a huge demand. And these type of commodities are pretty simple, honestly. They're pure, supply demand pricing. And when we get an uptick like this in iron ore, it means there's higher demand and higher prices can be charged to ship it. So, like I mentioned before, we had FOMC coming up later today. We'll see what happens. Probably they've been very transparent, so I don't really expect much. Quarter point rise, maybe a less hawkish stance. We'll see. But global macro developments could definitely impact this idea, right? And the economy has been contracting. We actually had the PMI also that came out showing more contraction. So, but this has been going on, for what, 9 months now. So it's not something new. If we look at this stock on a weekly basis, I have a weekly chart here of the company. This stock has the capacity to really get cranking. Okay, so after the COVID crash, this stock gained 500% in like 8 months from October to May. I mean, yes, a lot of companies obviously had huge price appreciation, but when this stock gets going, it can really move. And then it topped, it kind of bounced around a bit and topped really early of last year, and then kind of been sliding sideways since. But during that time, if you look at the revenue, 12 months trailing revenue, which I have on top of the chart here, climbed from 227 million to over $1 billion. So that's a 400% increase. And yes, the company did issue more shares during that period, but only in the rate of 11 million to 30 million. So what that means is that the sales per share pretty much doubled. Okay, it went from like 18 and change to 36. And that makes it very cheap on the per sales basis. So the price of sales is 3/4. It's 0.75. Now that's cheap on a kind of normal basis, but it's certainly not a good enough reason to get excited about this play. What I am more excited about is the cash flow. Okay, so this is a cash flow cow, and I have that. You can see it on this. It's a graph I on here. This is from last quarter. They generated pretty much $500 million, okay, in operating cash flow, and that is double from the same period previous year. And I was looking at the the last earnings call transcript. And they also secured forward cash flow with 3.2 billion in contracted revenue, and that's on top of 2.9 billion in net fleet equity. So another thing that goes into this is the age of their ships. So they own about 185 ships or so. but on average, they're less than 10 years old. And ships like this depreciates, obviously, like like a car would. But they're still going to earn close to $600 million more than fleet depreciation this year alone, which is going to boost their intrinsic value, I think. And there's something called a Compass Maritime Report I was looking at, and they state that a 10-year-old ship kind of in this category is worth around 30 million bucks. Okay, so times the 185 ships, so the gross is $5 billion more or less. And over the next 10 years, so after 20 years, the value of the ships will be cut in half to 15 million. So that's 1.5 million per year for one ship times 85 ships. It comes out to about $278 million in fleet depreciation annually. But which is, that's kind of a lot. But yearly earnings forecast for this year is around $20 per share. All right. So, and with 30 million shares outstanding, you have $600 million in bottom line profits, meaning the company will generate twice in earnings what is going to lose on ship depreciation, within the next 10 years. And they can actually start replacing these ships also without, adding debt or having excessive cost. So another thing I like about this company is, the revenue stream, since they are diversified, is not so focused on, crude or dry bulk or whatever. And in fact, the war in Ukraine has changed the patterns of longer haul routes, which is what these guys focus on, and basically made them more expensive. Because now they're more logistics to deal with, so they are now been able to charge more, especially with grains. So there's a lot of fundamental reasons why I like this play. Okay, but as you might know by now, I also pay a lot of attention to the charts, and this stock has now. I have a daily chart on here, and you can see it's kind of formed this long triangle over the past 6 to 7 months. Which is breaking out of stock is currently around $27. And you also see higher highs and higher lows, which is the very definition of an uptrend. I like to buy stocks in an uptrend. So I think this could be the early stages of a larger scale breakouts, which I intend to participate in. And so we'll see. Now, as far as options, because this is a stock that can move. Okay, and it's a very small cap company, so I'm not going to do spread. Okay, I just straight up bought the March 30 calls at 80 cents. So with that, I have unlimited upside potential, and these things also have a delta of 30 cents. So if the stock goes up $3, let's say, in a fairly short order, when earnings are released, that will pretty much double my options value. Even though they expires in March. And if it gets to, the upper range of about 35, which I think it could, by March expiry, these options will be worth $5, which makes it a 525% return. $500 gain on $80 cost, which I like to see. So so that's pretty much some styling up. We'll see how it goes.
Very good.
Ed, let's go back to you. What have you got next?
Yeah, so slightly controversially, I'm shorted Home Depot. So this, I don't know how big this is, $320 billion, trading at about 319. We all know what it does. But as I've written my template, let me read this out. Building materials, home improvement, lawn and garden, facilities maintenance, tool and equipment rental, 2,300 stores. Addressable market is $900 billion in America, and they've got 17%. So their annual sales are about $160 billion. Big old market. Right. They've split their business into two. DIY, for people like me, if I could do it, and the pro market. Now, everyone loves Home Depot. It's a lovely stock to have, especially if the market's slowing down. Very easy for lazy long only to buy it. because they think it's non-cyclical. I hear terms like it's recession-proof. And really, I don't think it is. But obviously, half their business is. So when things break, you're running a property portfolio. You've got to maintain it. You've got to fix it. Not that I would attempt to change anything or fix anything. You get a local builder to do a little job. He'll go and buy it from Builders or Lowe's or Home Depot, or you'd have a go yourself. So that is steady. The pro side of the market appears to be non-cyclical. And a large part of this is big renovation jobs. So people move into a new house. That's often the time, this is coming from Home Depot, when you'll take on a bit of an upgrade, stick in a pool or a conservatory or just fix something. Okay? So that clearly has a bit of cyclicality because the housing market activity has slowed down. They think it's non-cyclical, but I think it's primarily because for the last 15 years, because of QE and artificially held low rates, the asset that you're borrowing against for projects is just going up. So your house price is going up, you're borrowing money very cheaply, you spend 20 grand or whatever on a job, and your house seems to appreciate by more than that. So I think that part is what's under threat, because I don't think it is cyclical. It's just the housing market has appeared non-cyclical, nigh on nigh for 15 years. Just because if the Fed pivots or if it pauses, for me, it's not obvious why housing market activity is just going to reaccelerate and we enter a bull market. This is clearly a risk of the trade. So what I'm saying is, when you look at the quants, they're expecting zero revenue growth for 2 years and a tiny bit, like low single digit of earnings growth. They're in a business that's had inflation. So that means prices go up and you sneak a bit of extra margin. And that's why all of these businesses look like they're growing so well. Their sales going up, earnings going up. But they're not selling more units. They're just selling everything at a higher price with a touch more margin. What happens if it slows down? So if I'm right, there's just less footfall, there's less activity, there's less units being sold. Well, now as inflation clearly is abating, it's going to be harder to keep putting your prices up. Now, if they collude with Builders and Lowe's and they have a little cartel and they say, no one change a price, as our costs start to fall, will increase margin. Obviously, that's illegal. If they did that, their earnings could accelerate. But what these retail stocks, I think, might well find out is that as your traffic and your sales start to fall, pricing generally follows. And it's a super competitive market with people who know what they're doing. They will find the cheapest material. So if you don't keep your prices competitive, you're going to lose even more market share. So what my thesis relies on is a slowdown in the home renovation, bigger projects, a big decrease in activity for the professional flipper. You know, you buy a place, you do it up, you flip it for a profit. But now prices are coming down and now activity is slower. The economics of that ongoing last 15-year trend, the margins can disappear quite quickly. So I'm obviously assuming that that part of the market is obviously going to see less action. So we're left with a stock that is expected to have zero revenue growth. I think it might miss. Home Depot doesn't usually miss historically. And then I think the margins are going to come under pressure as this economy slows, not accelerates. And then you've got a margin contraction. And then you're talking about an earnings miss. Now, I love the fact that there are 22 buys, 10 holds. And last week, the second analyst made a break for the border, making a name for the institution, R5 Capital, whoever they are, put it on as sell. So I think there's a lot of people who think everything's going to be fine, good stock to own in this sort of market. I think there could be a miss. Now, in terms of price target, they're trading on 19 times for zero growth in revenue or earnings for 2 years. Lowe's is on about 14.5 times. Not quite as good a business. But I think earnings could miss 5, 6, 7%. And I think the earnings, the PE could come down to 17. And that gives me a price target in the 260 range, quite a long way down. I love it. It's a very sort of lazy long. In terms of structuring, earnings are coming out past the Feb expiry. So it's right for a March Feb calendar, 2 for 1. You could buy the March 315s. They're about $12, or they were 4 days ago, and just sell something like the Feb 305s. That'll be in for $5,000 as your net spend. You'll have about a 5 for 3. Collect the credit, depending on how the market's trading. Either sell your March 280 I put in here. You get $4 for those, probably more if the stock's heading south. And then if you collect that at 280, you'll get a 2.9 for 1. So again, very simple. Break it down into the business model. Read all the earnings reports to find what's expected. I love the fact that the management think that all the earnings growth is going to come from the pro segment. And that's great, because I don't think they do. So there is a pathway for bad news, and most people have got this as a buy. Home Depot, slot it.
I think it's a great space to look in, the kind of lazy longs that are non-cyclical, that all the kind of lazy managers will just crowd into. Cool. Let's go back to you, Ben. What else have you got for us?
Yeah, people like they think that just because it's a name that they recognize and they go to their store, it's safe. We'll see what happens there. But I have a short as well. Seagate Technology, ticker's STX. Okay, so these guys provide data storage, kind of old school data on drives and whatnot. And it's a $14 billion market cap company. And they just released earnings last week, which beat, by the way. Beat across the board. But just bear with me. You're going to see why I think this is still a short. Now, first of all, the whole space of tech, as we know, has been clobbered. And, as Ed stated with his first idea, there are some diamonds in the rough in the space. So clearly, but overall, by all accounts, if you look at the PMI report or even the relative strength, tech is is in the hole. And yeah, it's gonna rebound eventually, but these things take time, right? So we also had Intel that reported last week, missed across the board, and the stock gapped down, then kind of went sideways, and this is where it's at now. And, and all this can shift because we do have major earnings coming out from big tech, later on this week. So, but as far as this company, Seagate, this is really a story about the financials. Like if you look at all this financials of this company just looks super bad, right? So I'm looking at the latest income statement on a quarterly basis, and revenue fell quarter over quarter by quite a bit, 2 billion to a little over 1.8 billion. But then what also happened was that the cost of revenue actually climbed, okay, from 1.5 billion to 1.6 billion. So that means that the margins are getting squeezed, and gross profits pretty much cut in half, and EPS, diluted EPS on a quarterly basis, actually went negative for the first time, in several years. Now, switching over to the balance sheet, I don't go too heavily into this stuff, but there are some items that catches my eye here, and one of them is the cash and short-term investments has been falling. Okay, it was up a little bit, but to 770 million. But over the past couple of years, it's been on this kind of gradual decline. So this company just keeps on not only losing money, but having to dig into their liquidity to hang around. And then the other thing is, adding to that, liabilities have leveled off, but there's been a gradual climb in liabilities during the same period. So they now actually owe 10 times what they have in short-term liquidity. So that's just more for long-term liabilities, but also current liabilities are 2.7 billion. So if you look at something we call quick ratio, it is basically compare the current liabilities to the current assets minus inventories, is at 1.9 billion. Okay, so all these numbers, what do they mean? It means that the quick ratio, which is an acid test for financial strength, is at 0.7. So the company, if something were to happen, and all of a sudden they had to pay off all their immediate, all their immediate debt, for whatever reason, they can't. So as a company with a very weak financial picture, losing money and earnings going negative. And I don't, looking through this company, I don't really see anything to remedy this whole situation anytime soon. Now, obviously, if the whole tech space get a boost, this stock get boost with it. But I think this is one that's going to have a really hard time cranking higher. Now, if you look at this weekly chart I have of the stock with 12-month trailing EPS on it, you can see it here graphically how it's just kind of fallen off a cliff, while the stock price rallied from 50 to 70 and is now kind of hitting up this this 70 area. I have this also, you can see it a little more detail, okay, on this daily chart here. Another thing that I want you to take a note of is this green circle I have where the stock gapped up when it released earnings. So these gaps tend to work kind of as a magnet, if you will, where the stock comes down, it gets some support at the gap, people start buying it right around that price around 60 and change. And I take that into consideration when I structure my options. Right, so this is a trade that I get into a calendar. Okay, so you're now looking at the chain of the March and April puts. This is a bit of a longer term play. Okay, so I ended up buying the April 67.5 strike put at 390, and I sold the same size for the March 62.5 at 125. So the total cost per contract was $265 per contract. And tech is having a bit of a bid, and it could hold for some time. And I think this stock could hold above that gap at 62.5, which will mean that the short March will expire worthless at $125 per contract. And after that, I'll have more or less unlimited profit potential going into April. I do think the stock can get to $50 by the April expiry. I'm not going to bore you too much with the math on that one. But at that point, the long puts will be worth $17.50. So, I have $125 for the short premium. Okay, that was credited, plus the $1,750 gain in the long put, minus the $390 cost for buying it. That makes $1,485 per contract on the trade that cost me $265. So that's over a 5-to-1 reward risk. I like to see, we get these wrong sometimes, obviously. That's why I like to see a pretty massive reward risk. So when we get them right, we really get them right. So if this stock rallies and goes on a massive rally, I lose $265 per contract, but we do have pretty solid upside potential on this one. So that's that kind of wraps up that one.
Nice. Yeah, awesome. On that point, I mean, what we're trying to do with building long-short portfolios with options is reverse the distribution of returns that would be typical for certainly a long-only portfolio where you've got big negative tail returns. We're turning that into positive tail returns. So that was a really good example, Ben. Ed, is there anything you wanted to add?
Yeah, I mean, I think how a stock like STX Seagate has sort of traded through earnings is so sort of representative of the market we're in currently, and that is glass half full, soft landing. So a lot of stocks are reporting, and I think pretty average numbers with pretty average guidance. And the market's rallying through as if things are definitely going to get better because the Fed's going to pause and that's going to unleash a rally. And that's completely not clear at all. There's enough data on the soft or hard side to suit. But that's what the market's doing. It's set up for a perfect Goldilocks. And just the fact that the Fed stops raising rates is somehow going to improve end markets across many industries. So the fundamentals are still poor. So yeah, nice. I just wanted to mention Moderna, actually. Now, I only traded this yesterday. I haven't gone, written it all up, but it was basically driven. I better get it up here with the quants. Driven by Pfizer's results and their big sort of cut to their vaccine revenue for the year ahead. Now, we know these vaccine stocks are seeing huge reductions in vaccines this year versus last year versus 2021. So when you look at something like Moderna, it's about to report full year 2022. So it's already going to see earnings down 25%. When we look to 2023, revenue is going to fall $11 billion. And that's all just the COVID vaccine unwind. Earnings fall 85%. So the reason why I just bought some April 160 puts in Moderna after the Pfizer results was Pfizer downgraded quite aggressively. Okay. And so I think Moderna will have to follow. Now, that's pretty much it. Now, the only other thing to mention is Moderna's had a bit of a pop up above 200 recently. It's sort of around 169 now. And that was because they've had a bit of positive news on the melanoma cancer vaccine phase 2. So it's met its primary endpoint, which means the game continues. But the commercial reality is cancer vaccines are years and years away. They're also a very hot space, so everyone's trying to come up with the best solution. And the full data hasn't been released, so it's far from a racing certainty. What is a racing certainty is that, COVID vaccines are waning. And as much as they're going to lobby and they're going to try and, they're always trying to lobby for more legislation to force more vaccines into whatever, at age whatever, it's in a big decline. And don't forget, you Yanks, 11th of May is a big day. That's when the public health emergency is officially over in the US, not on the 10th, not on the 12th, but on the 11th. Yeah. So Moderna's economic reality is that this massive gap is just there. And their pipeline is still years away. So we know what it's like with biotech. There's always a risk. Tomorrow there's a headline, some amazing new breakthrough, some clinical trial progression that can always see the stock rally. But I think the market's completely wrong on this. I think the price is completely wrong. I think it could fall precipitously this year. So all I've done is bought some April 160 puts. There's a bit of momentum to the downside. Be interesting to see what Ben thinks. If the momentum slows, then I'll hedge it. I bought well out of the money at the time. I can always sell some February 155s, try and collect the credit, and then do the same for March. And then obviously, hopefully write it down. But I just wanted to mention that. So this has been on my action and watch list for a while. And the trigger was the Pfizer results yesterday. Moderna.
Awesome. Ben, have you had a look at that one?
Yeah, no, I was going to say, I definitely see that stock not rebounding anytime soon. I mean, with these like biotechs, sometimes you get some funky moves, but this past few days, it's kind of break down below like 180, 175, and now today just below 170. Yeah, does not bode well. So yeah, I might look at that one myself actually.
Excellent stuff. It's got the green technical stamp of approval, which makes me feel very good.
Okay, gents. Well, we'll wrap things up there today. It's been great to have you guys on talking markets and sharing some ideas with us all, which I'm sure everyone finds very useful. Thank you both for coming on. Look forward to catching up with you again on What's on Your Mind in the near future. Now, for those of you watching, there's a couple of webinars that I want to point out to you guys coming up this month in February. The first of which is on the 11th of February, and this one's a really important webinar for all of you guys that are ITPM alumni, okay? Since what we're going to do in that webinar is update you on a key piece of infrastructure that we're launching in the next few months. So I'll say that again, if you are ITPM alumni, then make sure you sign up to this webinar on the 11th of February. You guys are going to get, I guess all I can say is you guys are going to get a ton of value from this. Okay, I can't really say any more than that. You'll see on the webinar. Aside from that one, we've got another webinar coming up a week later on the 18th of February for our ITPM newcomers. Okay, so our first timers, that one's going to be titled How to Find the Best Trade Ideas on the Planet. That's with Ed Shek here and Anton Creel. Obviously, by the title, you guys know you're going to get loads of value there as well. Looking forward to seeing you guys all on that one. And yeah, that's it for this time on What's on Your Mind. And we'll see you again in a few weeks' time.